don't worry about it. I think getting faked out is totally natural. There's gonna be traps. I've really tried to take the perspective of I can always get back in.
Welcome back to today's Master in 5. I have Tim Grittani here, and we're gonna be talking about a very, very common question that we get, and that is how to deal with stops and not getting faked out.
Right.
So
Yes.
like, how do you deal with that, or what would you tell people who are just asking you that question?
I have a couple sort of different thoughts about it. My first thought, and really what I've kept for most of my career, is don't worry about it. I think getting faked out is totally natural. I think that it's totally acceptable.
Yep.
I mean, especially in the small cap space where they're a little more manipulatable, like there's gonna be traps. And it does get frustrating to, cover a short right at the top on a high day break, and then it stuffs within a couple percent and just bottom drops out. But I've really tried to take the perspective of I can always get back in, because getting faked out and having to re-enter, sure, maybe you lose a few cents a share between the exit and the re-entry, and commissions, but like that is such a small problem compared to the couple that aren't fake outs, and then all of a sudden you are getting squeezed like crazy, and it can happen really, really fast. Like how many do we see break high a day and then go into a volatility halt? And then reopen, gap up after the volatility halt, reopen much higher.
100%.
So, like, I get it. Like, you don't want to be wrong. You don't want to feel like a fool stopping out, high a day.
Yep.
But it's just which problem is worse. And I think a stubborn hold where you get caught in a huge drawdown and then all of a sudden you might have to start forcing yourself into weird decisions like, oh, well, I can't cut here. Like, it can get out of control so quickly. Now, what I will say is that with some of the algo work I've been doing, that has been on my mind. I do want to minimize the number of unnecessary cuts I take. So if you are really concerned about it, if you really want to try to find some way to do a little bit of prevention, I think you've got to have a really solid data sheet in place, like something where you can gather all the samples of a specific setup and you can say like, okay, for all these ones that broke high a day, well, how much above high a day did they get?
Yep.
You've got to have hard data on it. It can't be a perception versus reality thing.
Absolutely.
So like I will look at my data sheets on my setups and I will try to say like, okay, you know what? Like I could avoid half of my stop outs if I gave it like 2% wiggle room. Well, then I'm just going to build that into the plan from the start.
Right.
So if I'm going to enter a position, I'm not going to say, oh, I'm risking high a day. I'm going to say I'm risking 2% above high a day. And by the way, these are hypothetical numbers right now. I'm not saying give everything 2% wiggle room.
Absolutely. And you're saying know your data.
Know your data,
right.
For sure. Know
Absolutely.
your data, because that is where good decision making will come from.
I want to take this time to say thank you to our sponsor, Cobra Trading. Cobra Trading is the go-to broker for day traders and short sellers. And I'm not the only one saying this. In fact, Benzinga awarded Cobra Trading as the go-to broker for short selling. They have a heavy focus on direct market access order routing, so you have the fastest execution. They have some of the best locate prices and availability. They also have amazing customer service. I've experienced many different brokers, and it's why I use them every single day and why I'm proud to have them as our sponsor. Sign up now by clicking the Be the Trader referral link below and earn 1 free month of software with Cobra and 25% off all commissions. Now let's get back to the show. 100%. I know some people are probably thinking the whole thing of I can always get back in. Mm-hmm. The challenge with that is, some people will hear that and they'll get, faked out real quick. Yep. 1 minute candle, wicks out, they hit their stop, then it goes down and they're like, I can get back in. So they just get back in and then it wicks out again.
Yeah,
so like there's a balance there. Could you explain that? Because like some people will hear that and just put that into practice literally, like just get right back in because I think I immediately got faked out without giving enough time to breathe to really make sure. Could you explain that?
Yeah, so I would take a couple of approaches to that. Like, yeah, I don't want to short the first sign of weakness necessarily, because I've talked in the past about how you could have something that's an afternoon breakout, for example, where then it does dip back below the breakout level before continuing and ultimately being a very successful long play. So same sort of thinking could apply to a short. Like if it's just a small dip, you don't necessarily want to chase that weakness. Like the only case where I'll feel like, oh, I need to get back in quickly is if it like is really a slam candle, like it just gets obliterated. And then I'm really not chasing that weakness. I'm waiting for a pop to get back into, and then whatever the stuff level was becomes my new risk. In the case where it's more like, okay, it broke high a day, it didn't break by much, and now it's a slow fade.
Right.
Then I'm more patient. Then it's let's wait for some kind of like more significant snap and trend break.
I'm glad you said that, because me coming up in the trading, like I used to take that kind of wording literally.
Oh yeah.
A long time ago, and I would like, you take multiple small losses and then ultimately still be wrong. And that could be frustrating. So I'm glad you clarified that. I appreciate it so much. If you guys have any questions at all, make sure to check out Tim Grittani. I'm gonna have links to his social below. But again, brother, thanks again.
You got it.